to all of you. I already see so many people joining right away. That's always a great sign. My name is Pragya. You have seen me before. I'm the head of marketing at RevGenius. And today I am so excited to bring to you an amazing session about GTM efficiency and revenue architecture masterclass held by Shari and Jim Hopkins from Winning by Design. So, of course, as we always do, make sure you interact with each other. Drop your LinkedIn URLs in the chat. Give me a signal in the chat if you can actually hear me, see us on the screen, if all of that is looking good. And do tell us where in the world are you joining us from? It's always nice to know what part of the world are the speakers speaking with. With that, Shari, I'm going to hand it over to you to run this session, and I'm backstage if you need anything.
Amazing. Thank you. Nice to see everyone. I'm happy to be here today. My name is Sherry Johnston. I'm the Chief Operating Officer at Winning by Design, and I have with me Jim Hopkins. And Jim, why don't you do a little intro on your side?
Hi, everybody. I'm a revenue architect with Winning by Design. I like to call myself a recovering marketer, but do consulting work and work with clients for Winning by Design.
Amazing. So Jim and I have had the lucky benefit, at least on my side, for working together as operators as well in the last 5 years, consulting at Winning by Design. So what we want to do here today is share our experience, both from both seats of the house, on how we are seeing the move to go-to-market efficiency in the market. And we also are going to share, not beyond our experience, a look at some of the data behind the 72 different public SaaS companies out there, and why we are seeing the movement from growth at all costs to go-to-market efficiency in the market, and the importance of running on a really unified platform to achieve that go-to-market efficiency that you really need to help you scale. So today we are going to cover 3 different buckets in this presentation. And so for our agenda, we have about an hour together. Our end goal is really, what we want to do is help you guys walk away with how you can tangibly look at taking away where you can provide efficiency in your organization. So what we're going to be doing is sharing some data around why we believe it's the growth at all costs, to give you some background. We'll kind of use some analogies around how some other industries have benefited from providing standards such as production lines in factories. And then we're also going to go into the meat of it, of really showing how you can achieve sustainable growth by running on a revenue architecture framework, and the 6 frameworks for running a go-to-market team. What we believe strongly is that if you look at other industries, such as we talked about lean manufacturing or ISO 9000, or even when you buy a house in real estate, you go to a certified real estate professional. But in go-to-market, we have a bit of a free-for-all. Jim and I can attest to, as operators as well as our own clients, how a new executive can then change the whole structure of your go-to-market team. And really, depending on individual silos of executives, to run a unified go-to-market model is just really not efficient and not the way to go. So yeah, we're excited to share those things with you today. As I mentioned, the end goal being to help you really go back to your office and align with your team on 1 or 2 ways you can drive go-to-market efficiency throughout your whole go-to-market engine. We have, in the resources section, uploaded a workbook that will help you do that. You can download that there. I believe the team will also be sending it out in the follow-up as well, in case you don't get to that download. All right, so stepping back a little bit around go-to-market, one thing I'll ask you guys all, and if you can input in the chat, what we want to show is that go-to-market does play a different role depending on the stage you are in your organization. So, how many of you are in that 1 million to 10 million ARR stage? You can put in chat, just a thumbs up, or acknowledgement. But in this stage, you're often looking at, especially closer to 1 million, you are focused on product, as you should be, and your go-to-market motion may look a lot like founder-led sales, and everyone all hands on deck of learning how your customers are using your products to really get to that product market fit. So I see quite a few of you in that stage. So that's probably what your reality looks like, where go-to-market is a much smaller part of what your significance in your organization is, and rightfully so. But once you get to 10 million to 100 million, you have product market fit and you are looking to scale. So how many of you kind of fall in that bucket of the scale up stage of where go-to-market starts to become an increasing importance in your scale up? Oh, I see some thumbs up. Great. So, and then as we move even to 100 million and plus, and you're starting to get to public company zone, there's even more pressures on growth and go-to-market scalability, and that becomes even more important in how you're looking at the market. So what we are seeing in the market, however, is there are 4 areas that are indicating that right now is really the end of growth at all costs, and how we really need to move to this go-to-market efficient. What we saw that there was really unsustainable, cost-ignorant growth in SaaS from 2011 to 2021. It really led to this market reset, and really have outgrown this growth at all costs and really much mature to a much more cost-efficient, data-driven, and sustainable growth model. The second indicator that we have seen is the decline in growth rate. Since the market reset, the growth rate has fallen to about half its previous rate, and the cost of growth has increased by 1.6x. And the third indicator that we are seeing is the cost of growth. NRR has also started to fall precipitously, which is a trend that we continue to see in 2025 as well. So these 4 factors are really where we're seeing the move to need to go-to-market efficiency in the market. The data that we're providing here is provided by our partner, David Spitz of BenchSights. You can go to his site, benchsights.com. He also provides a lot of our benchmarking data against our bowtie methodology. But the data you see here is an aggregate of 72 different public SaaS companies. So as I go into this next section and often want to cite the source, this is where it comes from. So, how are we calculating what is go-to-market efficiency, and, how do we calculate that? So really is quite simple. It's really how much money is it taking me to acquire revenue from customers, both acquisition and expansion. So to explain this, we're going to use a new go-to-market efficiency calculation to assess the dollar of investment needed in sales and marketing to achieve $1 of NRR, or excuse me, net annual recurring revenue. So simply put, go-to-market efficiency factors are 100%, meaning it takes $1 in marketing sales to acquire $1 in incremental ARR. So of the 72 public SaaS companies we analyzed, over the last 5 quarters, we can see a trend that acquisition costs are well over $2 and trending up in sales and marketing to acquire $1 of revenue. So $2.50 is the medium, and right now it's really been the worst we have seen in the last 5 years. 41 of the 72 public SaaS companies are underperforming post-IPO. And the market has increasingly valued efficiency over growth at all costs. Achieving this go-to-market efficiency can really dramatically increase your company's long-term value and sustainability. We'll show some data that shows that, because I think the growth at all cost era, we weren't really seeing a lot of downside to to spend, and the downside of utilizing a lot of resources to acquire customers. But what we see is that it can be done. At the top of our rankings, the 10 successful SaaS companies here have efficiency below 100%, and some trending even better, proving that go-to-market efficiency really can be accomplished. So it raises the question, what strategies are working for efficient companies and least efficient ones? And how can SaaS companies return to growth without spending, so much to acquire new customers? So back to, why this, we see the results of go-to-market efficiency declining. And, this really brings it home in the outcome of why it's so important to achieve long-term sustainability and value. So you'll see that the companies with larger go-to-market efficiencies have higher valuations as well as higher stock price. So yeah, we talked a little bit about why go-to-market efficiency is so important, and hopefully I've convinced you that that's the case with this data background. And I'm going to turn it over to Jim to talk a little bit about how we can think about go-to-market efficiencies in other sectors to learn from providing that structure in go-to-market.
Yeah, thanks, Sherry. And the growth at all costs era might have been a lot of fun for some of us. We got to go to a lot of parties, and we got to spend a lot of money, and go to conferences and watch the orders come in. But go-to-market efficiency ultimately is going to be the sustainable way that we drive business, and that the sustainable way that we can maintain our livelihoods and our jobs and have fun longer term, right? And I think the analogy of looking at manufacturing, looking at factories is a good one. We think about kind of the older industries in our society, and we think about the Industrial Revolution, and these companies did go through a big boom, and they've sort of settled and maintained over the course of time, and they've had to deal with that kind of period of where efficiency became critically important. So they put things in place to help to maintain that and help to achieve durable growth. I'm curious, in the chat, you can say, is anybody in the manufacturing industry? Anybody know about these things firsthand? Would be interesting to know that. And we do see recurring revenue and SaaS playing a part in manufacturing more and more these days. Have some clients that are in that space. But if we think about manufacturing, if we think about factories, there's sort of three big highlights, three big focuses that factories have. They want to achieve high volume. They want to make sure they're producing a lot, productivity, and kind of getting products made, right? But they want to also do it cost efficiently. If they're not doing it cost efficiently, they can't kind of compete, especially with commoditized products. They can't compete on, the prices that are out there. And then third, they want to make sure they have good product quality. They can't continue to make and continue to sell products if they're not high quality, and if customers don't appreciate and want them long term. If you don't have sort of repeat customers, right, that keep buying a product or keep appreciating your quality. So what is the analog for that in recurring revenue, in SaaS, in go-to-market terms? And we think there's really clear analogs. So first, we need to grow the business, right? We all know we need to acquire new customers. That's been a focus of go-to-market for a very long time. And it is rightly so. We need to, especially early in our journey as a startup, we need to make sure that we're acquiring a new set of customers. And then we also need to do that efficiently. We've seen, and Sherry has talked about how the importance of go-to-market efficiency is really critical. But then we also need to make sure that we're getting high quality customers. And this is where retention and expansion play a really critical role. And it's often overlooked a little bit in recurring revenue businesses. This is the customer success, the support, the onboarding, the adoption of our products. And we need to make sure that that's a continuous experience, right? We acquire customers, we do it efficiently, but then we keep growing and nurturing those customers. We keep delivering impact to them so that they continue to be productive and they are durable customers going forward. So just like a factory, our go-to-market can have multiple product lines. And in a factory, you would measure and you would equip these product lines individually. Often we overlook this in go-to-market. We kind of lump everything together and we apply our go-to-market models, our tactics to different production lines in the same way. And that can be damaging as well and create inefficiencies. So in a factory, we're creating production lines to make specific products, right? In a go-to-market sense, we would create go-to-market motions that are unique for different markets, different types of customers, so that we can reach them in the most effective way. Especially once a business surpasses that $10 million ARR mark, we need to get serious about implementing these factory-like processes with specific go-to-market motions. Just like we talked about, high volume at high quality, a revenue factory, if we're building a factory for go-to-market, we should be able to produce revenue growth and high retention rate with these more efficient product lines. So not applying the wrong kind of salesperson, the wrong kind of prospecting tactics, marketing tactics to markets where it's not efficient, right? We need to make sure that we're efficient in each of our go-to-market motions. And then ultimately, this leads to the idea, Sherry kind of hinted at this, to have some standards and some certifications and some things that kind of lead us to a common sort of threshold of excellence and a threshold of knowledge and understanding that can be applied to go to market in a similar way. And we can learn this from factories as well, right? They have standards that they go by that are maybe industry based or specific to safety and hazard and quality standards. But then also kind of this certification, we're certifying people on how to do this in the best way. The operators, the people that are involved in these processes need to know what is best practice and what is standard. And then we need to make sure that we're continuously improving, that we have measurement in place, that we're looking at things really carefully, and that we're making sure that we address issues as they arise and we're fixing those issues and have really, really good telemetry of our systems and of our factory machines. So that's what we want to get to, and that's what we're working with our clients on. How do we get to these sort of standards and certifications and these ideas of continuous improvement so that we can have a really well-oiled machine, a really efficient machine of go-to-market. So Sherry's going to talk about in the next section how we take some of these ideas, these principles, and we apply standards, we apply some models to really set our foundation for how we achieve efficiency.
Awesome. Thanks, Jim. So this is really the meat of it here, everyone, where we're going to talk about, okay, we've talked about the reason to move to efficiency, the standards and other types of industries that have provided it. And then we're going to go over the actual SaaS standards that you can use to apply and provide more go-to-market efficiency throughout your organization. So we have actually trained over 3,000 revenue architects on revenue architecture. And what we have is 6 models that have that are providing the structure for a sustainable and efficient go-to-market model. There are 6 of them here. You'll see the revenue model, data model, mathematical model, operating model, growth model, and data go-to-market model that are all taught in our revenue architecture course and in the book that Jocko, our founder, has written. But we are going to go over, in the interest of time, we touch on 3 of them that are most applicable to driving go-to-market efficiency. So as we talked about before, where we commonly see a huge occurrence where these models are not ran across a go-to-market team with continuity, and that causes a lot of a misalignment within teams and inefficiency between customer success, marketing, sales, prospecting, etc. So what we want to do is show you some structure that how you can align on these these motions with a unified approach. So the three we're going to touch on: the data model, go-to-market model, and growth model. And I'll touch kind of focus on the data model first, which is kind of our tried and true model that you guys probably have seen in the organization, which we call the bow tie. So, and reoccurring revenue really starts where the funnel stops. So many of you may be familiar with the former Serious Decisions funnel approach that many people will use. That is a great way to think about a unified acquisition strategy. But really, in reoccurring revenue, a lot of or in some cases, most of our revenue comes on the right side of the bow tie. So after the funnel stops. So really having a more unified view that is focused and bespoke for go-to-market motion of reoccurring is really important. So, Jim and I like to use analogies. We're both big Warriors fans. Is there any other big NBA Warriors fans out there? All right. Well, one of the key pieces of the data model or winning by design philosophy in general is that reoccurring revenue is the result of reoccurring impact. And we like to use the analogy recently. You guys might have seen that one of our flagship players, Klay Thompson, while still a solid player and still sinking threes quite consistently on the court, he just really wasn't providing the impact to the Warriors anymore like he used to, despite the fact that he still added a lot of value. So you can kind of see the difference between value and impact in that situation, where he's still a very valuable player, but he was no longer providing the same impact to the team. And we need to really think about that same type of analogy in reoccurring revenue. We have a higher bar than just adding value from our product. We need to provide our customers impact in order to get that renewal each year, that expansion each year, that is so critical in reoccurring revenue businesses. So the data model really provides that standardization across across your conversion rates, where you can have a unified customer journey that you are looking at as a team. So here you'll see both the data structure that goes along with the model, so that you have a unified way of understanding where gaps might be in your customer journey, as well as really aligning the more emotional experience your customers receive throughout this entire journey. Your customers don't go to marketing and think that they're interacting with your organization's marketing department versus sales. They think of you as one company. So making sure that your go-to-market model is aligned both from a data model perspective as well as a data structure perspective is really key to providing that efficiency throughout. All right, I'm going to go through then the go-to-market model here. Actually, well, before I pass it off to Jim to go over the go-to-market model, I'll just have to say this is one of my favorite models. I think we've all seen, and Jim will touch on this, but a fair amount of efficiency that can be gained by using this model, where it was a piece during the growth at all costs era that I believe there was a lot of missteps on.
Yeah, thanks, Sherry, and really appreciate you introducing the data model. There's a lot to unpack with the bow tie, and a lot to get into, and not a lot of time for us to do that. So I encourage you to take a look at some of the materials. There's materials in the workbook. You can check out our YouTube channel. There's information about the bow tie there, but a really great model for being able to measure your full go-to-market and being able to see how it's functioning. And kind of, I talked about telemetry, but how to check the telemetry across the system and see what's affecting the system both downstream and upstream. So with the go-to-market model, we take a look at those different motions that we talked about and the different production lines in our factory, and we try to match them up to what will be most effective, what will be most efficient for reaching the types of customers that we're after. And really our focus here is how much recurring revenue can we expect from these different go-to-market motions, and how do we match our resources to the sort of the size of the market or the size of the opportunity that exists there. So the way that we look at this is sort of on a axis factor here. So we're looking at, on the x-axis, average customer value or average contract value, ACV. So how much is a contract worth for a new customer? So that's what we're going to look from left to right. It grows over the course of that axis. And then we want to look at sort of deal volume. And this is sort of logarithmic and just an estimate of things to just illustrate. But we're talking about, are we selling tens or hundreds or thousands or, tens of thousands of deals in a typical year or typical period. So as you see from left to right, as we go higher in ACV, we would expect the deal volume to go down, kind of linearly with that. And we would expect that different go-to-market motions would work at different tranches of that ACV. That as we rise in ACV and as we kind of lower the volume of deals, that we would kind of change up our go-to-market motion. You can see across the top, we've sort of labeled these from no touch to low touch, medium, high, and dedicated. And in each of those sort of segments or each of those tranches, like I mentioned, we would expect to kind of change or switch a little bit the way that we go to market, the motion that we apply. And there's several reasons for that. One of them is that we earn more money from each deal, so we have more money to spend, right? We can invest more money in acquiring customers and in servicing customers, renewing and expanding customers, because we're earning more money. It's more economical, right? We wouldn't necessarily want to approach a sort of low volume or high volume and low ACV customer with a high touch motion. And similarly, we wouldn't want to touch a high contract value, low volume type of market or customer with a no touch motion. Sometimes that's applied, sometimes it can help a little bit, but we want to make sure that we're matching the right go-to-market motions with our ACV. There's also the factor that as ticket values get higher, and we'll see this in high touch in particular, the higher price requires more consideration by the customer. That equals a longer sales cycle, more people involved, and usually higher level stakeholders to give their approval and to sign off on those deals. Those higher level stakeholders don't typically respond to sort of the low touch awareness tactics, the low touch marketing and prospecting tactics. They're only really reachable, and they only usually respond to a more targeted approach. And then ultimately, we want to make sure that a high touch motion really suits the market that we're going after, that the ACV matches with the high touch, and the high touch really is sort of within the bounds of what we can apply, or what we can afford in terms of customer acquisition. In this sort of tranche, or this segment, we would expect field sales where the seller would get face time with the customers, at least occasionally. They would get in person a little bit. Targeted marketing would be applied, so usually account-based and even one-to-one style campaigns or plays would be applied in this high-touch zone. And then more dedicated customer success resources that know the customer's business and can apply best practices by segment or by industry.
Jim, I'll just type in, there was a question in the audience back on the data model from Christian around a table format. And I'm guessing, Christian, you can clarify, but you're kind of looking for the data behind that in a table, if I'm not mistaken. We do, so similar to Serious Decisions, the data model is, we do track data. You can look at the Bench Sites data that I linked in there to benchmark yourself against different filters. But obviously, depending on your just like this go-to-market motion here that Jim's showing, depending on if your ACV range, your benchmark data may be very different. So you can use those filters to get as close to your particular company attributes as possible. But as we always say, the best benchmarks are against your own. So so that hopefully that helps, but happy to clarify if that's not what you were asking, Christian.
Yeah, absolutely. In working with clients, you know, the benchmarks are good for directional purposes. Seeing trends in your own data is really the key that you want to use going forward. And thanks, Kenny. We appreciate your calling out the revenue architecture book. It can be a deadly weapon potentially. So if we think about medium touch, if we go kind of down the x-axis and we think about what we would apply to that sort of medium area, this is where we find a lot of companies that are, you know, kind of selling to mid-market. They're sort of in that middle area. There's a good bulk of recurring revenue companies that are selling solutions that are in the tens of thousands of range. But their struggle is really often striking the balance between more inbound marketing or demand generation tactics with the marketing motions that they're doing, and also on the sales side, striking the balance between outbound targeting and prospecting and sort of inbound management of leads. So it's really kind of that middle ground where you have to strike that key balance. The data model will help you to do that, to really fine tune it. But the keys are really having clarity at an account level, what your ideal customer profile is and what your target account universe is. This will help make you more efficient, where you can kind of judge who would be a likely good customer and be able to have scoring, kind of data-driven inbound scoring and outbound targeting to help you really hone in on who those right customers are. And then, of course, optimizing processes and making sure conversion rates are meeting the needs of your growth targets, that they're kind of setting the stage and putting you in a good position to meet those revenue goals. And then also, really key is being crystal clear about what pains we can solve and that we'll address, and what impact we will and won't provide. The key here, and some of the pitfalls that we see clients getting into, is getting into GTM sprawl, right? We're going outside of this realm of these two-stage sales motions and so outbound prospecting. We're getting outside and over our skis, and maybe talking to customers that are maybe a little big and they want things very custom and they want things that maybe aren't on our product list today. And we're getting kind of enticed by that and getting into that sprawl area. Of course, we can obviously pilot and test dabbling into new GTM motions, but we want to make sure that we're doing that in a specific concerted effort. And then, of course, on the low end, the low touch end, these are increasingly popular. We often call these maybe PLG motions, product-led growth motions. They're very typical of kind of a new technology, a disruptive technology that really relies on users getting their hands on the technology to test it and to recommend it, and kind of for it to catch fire and become viral. That's kind of the goal of a lot of the PLG motion. But it's really meant to serve this sort of low ACV and high velocity motion. That's really good at that. It's great for that purpose. There's a real kind of leap that you need to make with a PLG motion when it comes to serving more upmarket customers, right? Higher ACV deals and more enterprise companies. It becomes really tricky to then kind of move and skip all the way ahead to that high touch motion from a PLG motion. It can be used to support, and we've seen companies do this successfully, but takes a lot of effort. And we want to make sure that we apply our no touch or low touch motions to the right types of customers, and that it's a right fit. AI has really helped in this regard as well. It's poised to accelerate the trend in people using low touch motion, but we want to be careful how we apply it, of course, too. So that's the GTM model. We want to talk quickly about the growth model as well. And the growth model kind of takes into account that there's a natural sort of S curve to the way that companies grow. We sort of hinted at this in Sherry's kind of first graph. She showed kind of the stages of startup, scale up, grown up. And we see that kind of following an S curve, right? There's some initial kind of slow growth in startup, and we kind of are climbing up that incline to where scale up, then we're really kind of accelerating the growth. We're pushing down the pedal on our growth. We might get to IPO at some point, and we're still sort of in that steep curve of growth when we get to that grown up stage, right? We're potentially a public company or getting to kind of hundreds of millions of dollars in revenue. And then the idea is once we sort of hit those higher echelons of growth, we become more of an enterprise company. Efficiency becomes ultra important there because growth starts to taper off relatively, right? Our growth rate is slowing because we're already a large company, and adding, the double digit growth percentages year over year becomes a bigger deal and a lot more effort. So our growth starts to taper off and level off, but our key there is maintaining efficiency and achieving durable growth. So you see it following sort of an S curve. And what we've done with our clients is that we've seen that there's some key breakpoints in that S curve that should be followed if we're ideally going to achieve efficiency. And there are things that come first sort of early in our stages that we want to make sure we accomplish. We want to get pricing and packaging. We want to kind of go through that piloting growth stage of sort of superstar selling. There's maybe some more hands-on education and superstar tactics that need to happen to be able to convince the market to take a chance on this new product. Maybe some founder-led growth that happens early in our growth stages. But then as we get through those sort of product market fit stages, then we really need to focus on getting the infrastructure in place to set us up for the next phases of growth. What we see happen far too often is that maybe we're going through stage 2 or the breakpoint 2, and then we're skipping ahead to scalability, right? We're skipping ahead to 7, and we haven't necessarily gone through the process of setting a foundation, of a data model, of establishing and matching our GTM motions to the right markets and to the right customers, of creating a repeatable process to execute those GTM motions and to measure them and continuous improvement on those GTM motions. And what happens is that we try for scalability and it kind of fits and starts, right? And we kind of see a jagged growth curve rather than a smooth S curve. So what we see with our clients, what we work with them on, is making sure that we've hit these breakpoints, right? That we've addressed them at each stage. And if we haven't, how can we go back and get some of those pieces in place to really set us up, provide that solid foundation, and get our factory in the best place possible to achieve efficiency. So that's the growth model. And we've covered sort of the 3 highlighted models that we wanted to get into. And I think it's helpful if we go into some specific case studies or examples of customers who have dealt with some of these issues and applied some of these models. So I'll hand it off to Sherry for the first one.
Awesome. Thanks, Jim. So we've talked through the models, but to date, they've been very theoretical. So, a couple of challenges we see with our clients and that you might be running through your head is, exactly how do you apply this to your organization? And then the second one is that we recognize that many times there will be a hero and, oh gosh, I definitely need to unify my team around a standard data model and get everyone on the same page around running a go-to-market engine versus the silos. But you also have to get the rest of your team members on board. And so what we've done, and again, is the resources is linked in the little tools there, and we'll send out the workbook also afterwards. But is to really partner with the rest of your go-to-market team, or at least a few other champions, to figure out how you can partner to identify some areas in your organization that will help provide that go-to-market efficiency. And oftentimes this may be outside of acquisition. Lots of times our heads go completely just to acquisition costs and marketing as a way to drive efficiency. But what we want to do is provide you with some examples from our real customer base on ways we found efficiency throughout the entire go-to-market engine, to spur some creativity and thoughts about where you might structure. And I think, when we go into this with our customers and what we do a go-to-market diagnostic, it's often a little overwhelming where there's so many different areas, of course, that everyone can fine tune. But what we want to do is focus on the area that can provide the biggest impact for your organization. And those are often very different depending on where you're at and the style of your organization. So I'll start with one example here, which is the headwinds to expansion. So as I mentioned, it's important to look at how you can not just focus on acquisition, but lots of times the efficiency gains can be really on the right side of the bow tie or in our customer base. So we have an example here where our particular customer had, during the growth at all costs stage, had various segments of customers, but did not utilize an efficient process in the customer success, retention, expansion arm of the business, and really had a one-size-fits-all approach to the right side of the bow tie. So as an example, a strategic account that may have a $250,000 a year ARR potential was treated the same as a small customer that may have 5,000 ARR in revenue, and they did not really have a specialization within their customer success team. So what they were able to do is look at how great these efficiency gains would be by fine-tuning and creating efficiency in this spot of their organization, and were able to reduce headcount by 33%, but also increase 7% in retention, because they were able to give a much higher touch and better experience to those clients that were providing the most revenue, and were able to invest in more automated and self-service on the lower end of the market.
And I'll talk about the next case study, and I think you'll see through the course of these case studies how some of these models sort of overlap, right? Sherry kind of emphasized the data model, but you see sort of different GTM motions playing a factor here, and being able to apply those differently to different sizes of customers. So in this example, GTM motion is a kind of critical theme, and we talked about this just a minute ago, but in this case, we want to make sure that companies have GTM motions and alignment across their team on the GTM motions they're applying to specific markets, and that's across marketing, sales, and CS. So that requires a lot of cross-functional alignment. It might require somebody in an executive position to kind of drive that alignment and really enforce it, and somebody who's willing to architect these GTM motions across the team and across the bow tie. What we would normally see is that efficiency at the $10 million range equals usually one GTM motion, right? We want to focus on a single GTM motion that gets us to the next phase of growth in that $10 million range. We don't want to be sort of distracted by multiple GTM motions at that size. We want to really get growth right. And then sort of at the 50 million marker of revenue, we can start to think about how we can apply multiple GTM motions and diversify our growth sources. So this is kind of the visual way to explain it. Really, at that sort of $50 million mark, we see a second GTM motion coming in, a third GTM motion kind of building over time, and then maybe we have a second product, or we have multiple products that start to come into the mix as we grow, maybe new markets or new regions that we're diving into. But this is kind of the typical or the ideal kind of evolution of go-to-market motions over the course of time. What we saw with a specific customer is that unfortunately they were jumping the gun in this model, right? At 10 million, they were trying to have multiple GTM motions. They were trying to address SMB, mid-market, and enterprise, and they were doing it all with a very similar motions. They hadn't specifically kind of customized those GTM motions to the right markets. And what we saw is that that led to productivity issues. They were dealing with, low productivity, low attainment from their go-to-market teams. It was a security software company. And what they ended up doing is they saw that their mid-market motion was actually the least efficient. Upon further examination, they saw that their mid-market motion was the least efficient of all their motions that they had kind of sprawled into, and that they saw the team was best suited and their processes were best suited to double down on their enterprise motion and really hone in there. And it was the best fit for both their products and solutions as well as their team's skills and resources. So as a result of doubling down on this enterprise motion, they were able to reduce their headcount slightly by 25%. But in the process of doing that, they saw a 9% increase in incremental revenue per rep. So productivity per rep actually went up when they sort of refocused their team on the core go-to-market motion that they were doing the best at. So fewer overall reps, higher revenue per rep. The company overall went from 63 million to 69 million. And they realized overall that this was possible because they were cutting sort of the inefficient piece of their go-to-market motion, and that they were focusing really on sustainable growth and making that the priority. So that's the go-to-market motion fit example, and I'll pass it to Sherry to kind of cap us off with the last example.
Great, thanks, Jim. So this is the last example, as Jim mentioned, and I wanted to give you a little bit of a roadmap for how you would go about doing this on your own. So if we go back to the data model, we might look at that CR3 to CR4, and which is our close rate, CR conversion rate, and look at, oh my gosh, wow, this is really declining significantly, or is underperforming against benchmarks the most out of our data model. That gives us sort of a roadmap or a compass to understand where should we dive in and look at where efficiency gains can be allocated, and where should we really be spending our time. So in the example I just gave, we would look into productivity per rep and potential performance issues in this part of the bow tie. So based off of the first example, we may see our conversion rates on the right side quite low, retention and expansion well below industry answer, which would give us the compass to go that direction, etc. So using the data model to help you uncover where to find those efficiency gains is definitely the best method. That being said, I know a lot of you have a lot of intuition around where some of these, knowing your business well, where some of these efficiency gains can be uncovered. So this one is a common one that we saw past the growth at all costs era, where we just saw a huge decline in productivity per rep. And when we dove into the customer data, it often looked something like this, where we saw the middle performers, the top performers really reducing, those superstar reps that we typically saw in 2020 timeframe of 20%, really shrink to a real small portion of performers, 100% of quota or above. And then we saw increase in the bottom performers of less than 50% quota attainment per rep. And what we uncovered here is the need to, one, oftentimes the solution here was to really de-invest in the bottom performers, where often in our experience they were not able to move up What we want to do is keep moving these up to have a more 80% quota attainment or above result. And oftentimes that is not possible with the bottom performers. But what we can do is really try to get those 40% of the underperformers moving up through performance improvement. So this efficiency gain allows us to dive into divest in the bottom performers, invest in that middle underperforming and normal performing to move up their productivity. In this case, by reducing headcount in this organization by 28%, resulted in a 7% incremental revenue by having less sellers, but higher performing sellers by retooling, providing design to how they sell and using some of the top performers' best practices and skills to apply them to that middle performing group. So in the interest of time, I'll leave it at that for this particular case study. We gave you 3 examples, one of kind of on the right side of the bow tie, customer success. We covered productivity per rep. Would love to hear, in this case, we're huge interactive folks. So, please share as we've gone through some of these examples, where in your bow tie model would you hypothesize some of the most efficient gains can be, and please do take those back to your organization and be able to kind of help unify your team, etc. On where you can provide some value. So I'll take some questions here. We have Alex. How do you balance the need to create productivity gains for reps servicing SMB versus a customized experience to mitigate churn? Okay, so I think this is alluding to, so rep servicing. I'm not sure if you mean.
Yeah, so like right side of the bow tie, retention, expansion sounds like, and the need balancing productivity with the need to provide customized service. And I think
Sure.
I think it's definitely tricky. And Sherry, you can chime in to this too.
Mm-hmm.
I think it's tricky, but I think there are definitely ways that you can use measurement and data to help kind of trigger certain situations where the intervention is needed. I think that's a popular way to attack this. We call this sometimes trigger plays. And so we can kind of identify early on where there are potentials for churn, where there are opportunities for expansion, where there are certain stakeholders involved, and we want to measure that and track that really closely. So normally we would take, maybe more of a scaled approach to the customer success side of the business on a lower touch GTM motion, but we can use those triggers. We can use trigger plays to sort of automate a more hands-on approach, right? We can take a little bit more of a TLC approach to certain situations where churn is more likely or possible. So I think using data, using measurement, and having a process and a set of plays in place that are not, they're not as like handcrafted as maybe you would use normally. They're a little more like premeditated, right? You have these plays that you run, and they're more efficient for the team to apply because they've done them maybe multiple times and run these plays over and over, but they know how to kind of be hands-on and be customized, maybe in a more scalable and more efficient way. So that's what my mind goes to. Sherry, I don't know if you have other thoughts on that.
Yeah, I mean, on the customer success side, I would say the and sort of alluding to the first case study and how they approached it was really bifurcating by segment size. So the customers that were, as you mentioned, these larger organizations that needed the more customized experience had a different set of customer success folks that were more senior, that were able to provide that higher touch customer experience, where the SMB segment had much more self-service capabilities that they invested in to take out that human, more costly touch on the SMB side, where where providing that human touch is just too expensive to service that lower end of the market.
Yeah, I've also heard of companies even charging for, components of higher touch, right? Like getting credits for certain extent of customer service. It's one way to tackle it too.
Yeah. Jim, do you have any examples of plays that you can inspire the team from? Alex is asking.
Yeah, so the trigger plays would be something like the trigger would be a new stakeholder is involved in helping to manage the solution, right? Like someone leaves the organization and someone else comes in. So the trigger play there would be a set of steps that the CS person would take to kind of intervene, make sure the new stakeholder was up to date, and you have sort of a playbook that you would follow to kind of maybe have a meeting, maybe send them a piece of content, maybe send them a note, and you would have a set of steps that you take to make sure that the new stakeholder was on board and to avoid having to do like a resell, right? Like a full resell of the solution when it comes time to renew or expand. So that's just an example. Other examples of like low product usage. If you're getting low product usage signals, and how would you intervene there? What would the steps be? If you're getting maybe a negative escalation, what would the steps be to mitigate that? So it's really just taking sort of health signals, health triggers, and designing steps or plays that you would apply to mitigate those things and intervene maybe in a more custom way than you would normally in servicing a lower touch client.
Thanks, Jim. So Rob, I love your question too. Rob asks, a decrease in sales productivity can be due to go-to-market inefficiency that is not created by creating the pipeline support to support the number of reps. So I think in general, love this question because you can get a false positive, I believe, if you're not really looking across the entire data model on your go-to-market engine. So what we would do here, and why we focused in on productivity per rep, is when we ran the numbers in their go-to-market diagnostic, which is our most common service that we run at Winning by Design. We, their ICP or top of funnel metrics was not the biggest red flag for us between volume metrics and conversion rate. It was really that conversion rate on the rep performance side. But you're 100% right that if we just looked at the siloed metrics of just conversion of CR3 to CR4, or to even CR4 to CR5, we may make that false assumption and assume it's just the reps without looking at the whole picture. So I think that's an excellent question to really make sure you're analyzing your whole engine and not misdiagnosing where to dive in.
Yeah, it can often be upstream that the problem is occurring. Maybe we're not targeting the right customers. Maybe we don't have the right pain messaging mapped to the right segment of customers, and we haven't really checked that with the market. And there could be things upstream that are impacting that for sure.
I love all the questions. I think we have time for one more. I'll mention this one. What best practice in terms of sequence progression to get to an optimal set of go-to-market motions as the company matures and grows? Products to customer segment, industry verticals, and others.
I can maybe weigh in a little bit. I think this is an interesting mix. Normally, we drive sort of ACV by product, well, a mix of product and customer segment, right? So what the product costs, and this has to do a lot with pricing and packaging, right? We're getting into that realm, but what the product costs us to deliver, and then what the market supports in terms of cost. So ACV, again, annual contract value of our solution, is a heavy component of how we would match our go-to-market to the right mix. But that ACV is often driven by a combination of what the product costs to deliver with what the market will support in terms of pricing. So it really it really does depend a little bit on that. I would say that probably the most important component of go-to-market motions is what works best to reach the market that you're going after. So where there are unique kind of elements of that market. So are we selling to new higher level stakeholders in this sort of enterprise motion versus a more mid-market motion where we're selling to operators and directors? So that would probably be the driving thing, but I think there's product and other considerations that mix in there too.
Awesome. Well, thank you, Jim. I know we're at time. I am more than happy to help answer some of these questions offline that we didn't get to. I really appreciate the engagement. And yeah, this is how we can help drive go-to-market efficiency with Winning by Design through education, advisory, and consulting services. So obviously, if you need help, we're here to help. Otherwise, hopefully you guys have some good takeaways to provide efficiency in your own organizations.
Thank you so much, Shari and Jim. And of course, if any of you still have questions and you want to connect with the speakers, please do so on LinkedIn. They're always ready to engage more there. And thank you so much once again. I'm going to send a recap with all of the information, the deck, and the resources so that you can look at it at your own time. Have a great evening, everybody. Rest of your day. Goodbye.